Welcome back to the Working Thesis. If you strip away the software, the algorithms, and the elegant interfaces, the cloud is not in the sky. The cloud is firmly on the ground. And if you strip away the concrete and the steel of a data center, what you are left with is essentially an unimaginably dense, intricate web of copper.
Everything we have talked about in this entire series, the massive gas turbines, the nuclear reactors, the grid transformers, the cooling systems, the backup generators, it is all physically wound together with one single metal. Copper is the literal physical bottleneck of electrification. You cannot move a single electron from a power plant to an AI GPU without it.
Today, we're looking at Freeport-McMoRan, ticker FCX. They are one of the world's largest publicly traded copper producers, and they represent the raw elemental foundation of everything we have spent the last 6 episodes discussing.
We have walked from the electrical equipment layer all the way down to the fuel. Now, we hit the fundamental atoms. We hit the metal. We are going to look at Freeport's assets, the extreme fragility of global copper supply, the structural deficit looming on the horizon, and the intense cyclical risks that come with commodity mining.
This is episode 7. This is the series finale of the AI power chain. Let's close the chain. Quick, honest note before we dig in. This is just 2 curious people thinking out loud, for learning and for fun. It's not investment advice and never a buy or sell call, so always do your own homework. Let's look at why Freeport showed up on the screen right now. As of early July, the stock has experienced a healthy pullback. It is sitting in the mid-teens % off its recent high, and the momentum reading, the RSI, has reset back to a neutral level.
That technical reset is the initial filter. After a massive run-up fueled by the dual narratives of energy transition and the AI data center boom, the commodity took a breather, and the miners naturally followed suit. A mid-teens pullback clears out some of the froth and brings the stock back to levels where the market has to make a fundamental decision about the next leg.
Exactly. But as always, the pattern on the chart is just the starting point. It is just the first filter that puts the ticker on our desk. If you want to understand exactly how we use those technical filters to surface ideas, we have a separate methodology explainer video that breaks down the whole process. Today, we are keeping the technicals light and diving straight into the fundamental story.
To understand the Freeport thesis, you have to understand exactly how copper maps to the AI build-out. We talk a lot about the computational power of AI, but the physical reality is staggering. A single 1 gigawatt AI campus, which is the scale the hyperscalers are building right now, requires tens of thousands of tons of copper.
It is everywhere inside the facility. It is in the heavy busways that run power down the server aisles. It is in the miles of power cabling connecting the switchgear to the transformers. It is in the grounding systems. It is woven into the motors of the cooling units that companies like Vertiv build. It is inside the backup diesel generators. You simply cannot build a data center without massive quantities of this metal.
And AI is just the newest, heaviest slice of the pie. More than 70% of the incremental copper demand this decade is coming from the broad energy transition. We're talking about grid modernization, electric vehicles, and renewable energy generation. An EV requires roughly 2.5 to 3 times as much copper as an internal combustion engine vehicle. A wind turbine or a solar farm requires vastly more copper per megawatt generated than a traditional natural gas plant.
So you have this massive, multi-decade structural shift toward electrification globally. And suddenly, generative AI arrives and drops an unprecedented, highly concentrated baseload power demand right on top of it. All of it pulls on the exact same resource. Copper is the undisputed metal of electrification, and Freeport is arguably the most direct, liquid way for the public markets to own that physical reality.
Let's break down the business. Freeport-McMoRan is a mining titan. They are one of the largest publicly traded, near pure-play copper producers in the world. But their portfolio is concentrated in a few massive, world-class assets.
The crown jewel is Grasberg, located in Indonesia. Grasberg is one of the largest copper and gold deposits ever discovered on Earth. Then they have their massive North American operations, primarily the Morenci mine in Arizona, and major operations in South America, highlighted by Cerro Verde in Peru.
That geographic diversity is crucial. But what really defines Freeport is that Grasberg produces a massive amount of gold as a byproduct of mining copper. This is known in the industry as the gold kicker. Because gold prices have been structurally robust, Freeport can sell that gold and use the revenues to offset the enormous costs of pulling the copper out of the ground. It drastically improves their unit economics.
And at the helm, you have CEO Kathleen Quirk, who recently took over the top job after serving as the company's president and CFO for years. She is highly respected on Wall Street for her disciplined capital allocation and deep understanding of the global commodity markets. Freeport is not a scrappy explorer hoping to strike it rich. They are a mature, highly cash-generative industrial powerhouse managing some of the most complex engineering projects on the planet.
Because of those assets and that management discipline, Freeport holds a unique position in the institutional market. Bank of America, for example, has explicitly named Freeport-McMoRan its top copper pick.
When analysts look at Freeport, they point to a few core pillars: the world-class nature of Grasberg and Morenci, the falling unit costs aided by that gold kicker we just talked about, and a very strong balance sheet that gives the company flexibility regardless of where we are in the commodity cycle.
But there is another mechanical reason Wall Street gravitates toward this stock. Freeport has immense operating leverage to the price of copper. Because their fixed costs are largely set, every additional dollar the copper price goes up drops almost entirely to the bottom line in pure free cash flow.
Which means Freeport often trades as the ultimate sentiment gauge for copper itself. If institutional investors want to express a macro view on global growth, electrification, or the AI infrastructure build-out, they don't necessarily go out and buy copper futures. They buy Freeport. It is the ultimate proxy asset for the electrification theme.
But mining is an incredibly difficult physical business, and the supply side of the copper equation is shockingly fragile. We got a brutal reminder of this recently. In September 2025, a massive mud rush accident occurred at the giant Grasberg mine.
A mud rush is essentially a sudden, catastrophic influx of wet, muddy material into the underground mining tunnels. It is one of the most severe hazards in block caving, which is the highly complex underground mining method Freeport uses at Grasberg now that the open pit is depleted.
The impact of that single accident was staggering. It cut that unit's copper sales by more than 70% year over year in the immediate aftermath. And because underground mining at that scale is so tightly engineered, you can't just clear the mud and restart the next day. Full recovery and normalization of production from that disruption isn't expected until around mid-2027.
It is a vivid, sobering lesson. Copper supply does not live in a spreadsheet. It lives in deep, hazardous, geologically complex environments. When demand spikes, the software industry can spin up new servers in seconds. But in the mining industry, new Tier 1 copper mines take 10 to 15 years to permit, finance, and build.
You have a decade-long lag between the signal for more copper and the actual delivery of that copper. One accident at one major mine, and a significant chunk of global supply simply vanishes for 2 years. That extreme supply inelasticity is the absolute core of the long-term copper bull thesis.
So you have highly constrained, fragile supply on one side. On the other side, you have a demand curve that is turning structural. The grid buildouts, the electric vehicle transition, renewable energy deployments, and now the relentless march of AI data centers. They are all pulling on the exact same constrained resource.
Analysts across the board see a widening structural deficit. S&P Global published a landmark study projecting that the global copper shortfall could approach 10 million tons a year by the mid-2030s into 2040. To put that in perspective, the entire world currently consumes roughly 25 to 26 million tons a year. A 10 million ton deficit is a catastrophic shortage for the energy transition.
The problem is that we are simply running out of easy, high-grade copper deposits in friendly jurisdictions. The ore grades globally are declining, meaning miners have to move vastly more rock today to get the same amount of copper they got 20 years ago. It requires more capital, more energy, and more water just to keep production flat.
But there is one massive caveat on the demand side, and that is China. China consumes roughly half of the world's copper. While AI and Western grid modernization are the exciting new marginal drivers, the baseline demand is deeply tied to the Chinese property market. Chinese manufacturing, and overall global GDP growth. If global growth stutters, or if China slows down aggressively, that structural AI narrative will get overwhelmed by cyclical macrogravity in the short term.
Freeport doesn't operate in a vacuum. The competitive landscape for copper is dominated by a mix of specialized players and massive diversified mining conglomerates.
Southern Copper is one of their closest direct peers in terms of being a major, focused copper producer, though their assets are heavily concentrated in Mexico and Peru. Then you have the absolute giants of the mining world, BHP and Rio Tinto. Those companies produce massive amounts of copper, but they're also deeply exposed to iron ore, coal, and aluminum.
Teck Resources is another major player, especially after reorienting its portfolio to focus heavily on base metals and copper growth in the Americas.
But Freeport really stands out for institutional allocators because it is one of the largest listed near pure-play copper names available. If you buy BHP, you are heavily betting on Chinese steel production via iron ore. If you buy Freeport, you are making a direct, concentrated bet on the electrification and AI theme, with that very helpful gold sweetener on top to protect the margins.
We have laid out the bull case, but we need to be ruthlessly honest about the risks, because they are substantial. Copper is heavily cyclical. It is famously called Dr. Copper because it is the metal with a PhD in economics. It is deeply sensitive to industrial cycles, interest rates, and global manufacturing PMIs.
And as we mentioned, it is heavily dependent on China. The AI data center build-out is a phenomenal long-term demand vector. But if the global economy enters a recession tomorrow, the price of copper will plummet, and Freeport stock will get hit hard, regardless of how many GPUs the hyperscalers are ordering.
There is also the live operational overhang. The recovery from the Grasberg mud rush is ongoing. Freeport has to prove it can safely and efficiently ramp that complex underground operation back up to full capacity by mid-2027 without further setbacks. Mining is unpredictable, and execution risk at block cave operations is notoriously high.
Finally, commodity prices simply swing hard. Freeport is a high-torque, high-volatility name. When the copper price moves, Freeport's margins expand or contract violently. This is not a sleepy utility stock. This is an aggressive, cyclical commodity producer that requires a very strong stomach.
Let's look at the technical read, carefully framed. As of early July, with the stock in the mid-teens % off its high and momentum sitting at neutral, the market is looking for the next structural floor. On the downside, the first logical areas of support are its 200-day moving average and the spring low. If macro conditions weaken, the next major floor is a deeper multi-month low established earlier in the year.
On the upside, the immediate resistance is the 50-day moving average, which is currently sitting above the price action. Beyond that, you are looking at the prior high as the major overhead ceiling.
But here is the crucial caveat. For a highly volatile commodity producer like Freeport, the analyst price target range is extremely wide. We are talking about a massive spread from the lowest Wall Street target to the highest. That wide range should absolutely increase your caution. It tells you that even the professionals fundamentally disagree on where the commodity cycle goes next.
Which is exactly why you have to lean on your understanding of the supply and demand mechanics, and why you map the technical levels rather than blindly trusting a single price target. These are levels that move. They evolve with the copper tape. What you do with this map is entirely your call. We are not taking positions. We aren't telling you to buy. We aren't telling you to sell. And there is no advice to stay patient or not chase. This is simply the read of the landscape. Your risk is your own.
The one-line thesis for Freeport-McMoRan is this. The AI build-out is, at its physical core, a mountain of copper, and Freeport provides the most direct, levered access to that structural electrification demand.
But now we need to step all the way back. Over these 7 episodes, we have walked the entire AI power chain. We started with the terrifying reality of a roughly 7 gigawatt power gap facing the U.S. grid. We looked at the kings of electrical equipment, GE Vernova, Eaton, and Hubbell. The companies building the transformers, switchgear, and grid architecture required to handle this load.
We went inside the data center with Vertiv, exploring the liquid cooling technologies necessary to keep these massive GPU clusters from melting down. We looked at the generation layer with NRG Energy, proving that independent power producers are sitting on the most valuable real estate of the decade. We looked at the ultimate baseload fuel, nuclear energy, through Cameco and the uranium market.
And today, we close the chain with the metal that physically binds the entire system together, Freeport and copper. There is an old market adage, in a gold rush, buy the shovels, rent the miners. In the AI rush, the GPUs are the gold, but the power grid, the cooling systems, the uranium, and the copper, those are the shovels.
But it isn't enough to just say, buy the shovels. You have to understand the mechanics of every single layer of that physical value chain. Because a bottleneck at the uranium mine, a transformer shortage at the equipment manufacturer, or a mud rush at the copper mine all dictate the exact same thing, whether or not the AI data center actually gets turned on.
That brings us to the end of the AI Powerchain series. We want to thank you for walking this entire journey with us. The AI story is often pitched as purely a software revolution, an intelligence explosion moving at the speed of light. But at its foundation, it is a physical world story.
It is a story of heavy industry, of mining, of thermodynamic limits, and of electrical engineering. It is playing out on decade-long clocks that the software world simply cannot speed up.
Remember, every company we discussed in this series was presented as an educational map of the value chain. This was never a buy list. The market is dynamic, cycles turn, and risks are always present. Do your own research, manage your own risk, and always stay objective.
We hope this series has completely changed how you look at the infrastructure behind the algorithms. Thank you for joining us on The Working Thesis. We'll see you in the next series. That's a wrap for today. Thanks for thinking it through with us. We're just testing our theses out loud, one day at a time.
Catch you on the next one. Stay curious and tell us where we're wrong.